Good morning. It looks like we are live now for our SMSF webinar. I can see actually quite a few people already joining, which is cool. Just hit the raise your hand, just checking you can do two things, see my screen and also hear me. Thank you, Vivian. Cool to see you on. See Con there. Hope you're not too cold in Melbourne there, mate. Elisa, thank you, Elisa. Awesome. All right, we're working. And geez, I think we have almost more people live on the webinar today than we had on the JobKeeper one earlier this week. So, alrighty. Now, while more people join, I'm going to continue my little poll fun. So I've launched a poll now that asks, do you currently have a self-managed super fund? So what I want to do this morning is really tailor the morning for what your needs or wants or questions are. Webinars as a presenter, they're not often interactive, but I do want, some interaction here to be able to, basically you guide me what you want to hear. So I can see that basically 2/3 of the people joining actually have a self-managed super fund already. Actually more than 2/3 now. No, yeah. How cool. All right. And about 1/3 of people don't have an SMSF at the moment. So that's pretty cool to see. Thank you, Vivian. Now I will just quickly share those results with everyone. So that's question number 1, where we can see that of the people who answered, 15 are yes, 7 are no, which is basically 2/3 yes, 1/3 no. Now the other question I'd love to hear is, what do you want to learn more about when it comes to investing in SMSFs? Now this poll, you can actually choose more than one option. Multiple choice poll, yeah. And so, personally, I think cash is a little bit boring and straightforward, but is there any investments that you'd like to learn more about? Thank you for the answers coming in already. Whoa, okay, it's going nuts. Cool. Very, very cool. So there's quite a few property ones. Angel investing, own a business through super. How cool. All right, I'm going to keep that poll just open for the moment for any others who are joining. We've still got a couple more joining as we go. Also, just a heads up, I've got Rose who's manning the webinar with me today. So Rose is going to help with the Q&A or the chat side of things. If you do have a question, I'd just love you to hit the Q&A box and pop it in there. And Rose will just, thank you, Lisa. Rose will just flag it with me and we'll answer. And personally, again, I just want to invite you to ask a question if it is coming up for you, because most of the time someone else might be thinking the same thing. Very cool. All right, now I will end that poll on the investments, and I think you'll be able to see on the screen what people have voted for. So it looks like residential and commercial property are the winners, followed closely by property development and then shares and owning a business for a super. So and that's quite interesting, because property is actually one of the biggest reasons why people end up setting up self-managed super funds, is leveraging their money in super to purchase property of some form. So yeah, we've seen tons of it, and yeah, I can answer as many questions as you've got on that stuff, which is cool. Alrighty, and we officially do have more people live now than the JobKeeper webinar. So I don't know what's going on there, but it's pretty interesting. So in the invitation to today's webinar, I did say I'd touch on 5 broad things, which is commercial and resi property, which funnily enough was the most popular choice there. The other one is becoming your own bank. And so we're going to talk about using your SMSF to essentially become your own bank by lending money to others. And I'll kind of leave the detail for that. Investing in private companies. So that could be investing in a business that you're involved with actively, or like angel investing, where you're funding someone else's business. And then we will cover property development. That's a pretty special one that I love. Usually they're really intense structuring for those ones, but the results are amazing, where you can pull together a fair bit amount of cash, so you don't even need funding from the bank sometimes. And then, obviously saying this lightly, but an SMSF is actually our best tax structure here in Australia. In fact, I say tax haven because there's literally a tax rate of 0% if you meet certain conditions in super, and legally you pay no tax. So you don't even have to move to the Cayman Islands or, I think sometimes I get asked about, is Singapore a good idea? But self-managed super funds, you don't need to go anywhere for. And if they're set up right and you meet those conditions, then yeah, 0% tax on your earnings, on your profit, which is exceptional. Yes. Okay. In terms of my background in super, I thought it would be sort of logical to share what my background has been. Self-managed super is actually something I did in literally my first year of accounting, where I was helping to audit self-managed super funds when I was working at KPMG. So I've seen hundreds of them over the years. It's weird the experience I've got on that sort of thing. So I've seen the audit side of things, and yeah, I'd say it would be hundreds over the years. Been an SMSF member myself for almost 10 years now. I'm in a fund with my parents, which has been a pretty cool thing to see and actually be actively involved in. Also, I have seen compliant and non-compliant funds. So I have seen some pretty scary letters from the ATO when the biggest one I've seen is actually where someone literally drew most of their super balance out to live on it for a few years after he'd sold a business. And we had to pick up the pieces and help fix that for the ATO in the eyes of the ATO over the following few years. And my jaw dropped because at the end of the day, the penalties that he got weren't, in my opinion, very, very hectic at all. So again, I've seen non-compliance, but I'm absolutely not encouraging to be non-compliant there. But if you are in a position where you ever do become non-compliant, then the best thing to do is be on the front foot and fix it. And if they see you doing the right thing or moving in the right direction, then I guess it's a better outcome than fighting them. I've also seen some weird and wonderful and really questionable investments. So I'm not suggesting non-compliance, but it used to be allowed that you're able to have collectibles in your self-managed super fund. So I've seen things like collectible cars or even collectible artwork and things like that. And yeah, there's definitely some interesting investments I've seen, and you almost think, why would someone buy that in a self-managed super fund? But I've seen some weird stuff. That might be one for over a beer. I owned a business through an SMSF, so that I have actually, there's still an entity I've got owned through super that trades essentially. And I'll share how you can do that legally. And I tallied it up, and I'd say we've got over about $130 million worth of assets that we help our clients through with SMSF. So I have seen a fair bit of this stuff and different people's preferences. I also should say what I'm not. I'm not a financial advisor. I'm an accountant. I'm not giving you specific advice to do something from this call. In fact, if you do have any ideas or want to bounce anything off, you absolutely need help implementing some of these strategies. Basically, everything I'm sharing is complex and it needs to be done with care. If you stuff it up, there could be huge penalties and that sort of thing. So don't just take this and say, oh, yep, that's the idea, let's go and implement it without help. Yeah, this stuff needs assistance, or most of it does. I'm also not going to tell you to invest in a certain class of assets or a certain investment. So you can tell someone's probably ruined it for the rest of accountants out there. But my genuine desire on the webinar is to help give you ideas of things you can do with super. And it's definitely not personalized advice. And I do have that required disclaimer there. I am authorized to provide limited financial advice actually around the setup and closing of self-managed super. That was a requirement for accountants that came in a few years ago. Yeah, it's something that I need to include in these slides here. Okay, so I am going to talk about the detailed stuff, but I do want to give you an overview of SMSF. So this is maybe the people who don't quite, who don't have an SMSF, about a third of the people joining this morning, or it's maybe an overview of things that you might need to consider if you've already got an SMSF. So the first one here is up to 4 members in your SMSF. So you can actually have up to 4 people. Now, it's not limited to your family, but it's a good idea that it should be limited to your family because I'm going to say be careful of the 3 Ds. You've got death, disability, and divorce. So these 3 things are very complex when it comes to how you manage self-managed super funds, because if a member passes away, then their executor or their the director that steps in to take their place in the SMSF now controls their share. So you need to be careful of estate planning considerations, and that's kind of the same thing with disability. If you're in a fund with a member who loses mental capacity, then you may have problems actually managing that super, because you need to actually make decisions together when you're in a self-managed super funds in an SMSF. So you need to make sure the other people in your fund have stuff in place where you can still make decisions, or someone can for them if anything went bad with their capacity. Also divorce. Maybe if you're a parent thinking about bringing in your child into the fund, I'd say that's okay. And I'm in a position where my parents have brought me into their fund. But as parents, I would just really question whether you want the son-in-law or the daughter-in-law in there in the case, and we never want to see this happen, but in the case there is divorce, then you're not in a fund where you've got someone who you might not have a great relationship with, and you need to make financial decisions with them. So think about that. And that even goes for you and your partner. Like if you do get divorced, then we need to look at how we break apart the SMSF and split the assets and that sort of thing. So we need to kind of think with these things in mind. The other 2 might not be guaranteed, but death is definitely guaranteed to everyone. So we need to make sure we've got a plan for how that happens gracefully. And it is added complexity when you've got a self-managed fund. Alrighty, now this one down here. The most common question I get when someone's exploring self-managed super is actually, when does it make sense? Now, the answer to that is never simple, because it depends on what your current super is doing and what the performance is like there. But also, I'd say this is probably the most relevant question is, what do you want to invest in? So what sort of assets do you want to use your super for? If you're going to close an industry super fund, set up an SMSF to invest in a term deposit, you'd be nuts, because the fees would I'd say you'd need a couple of $1 million before the fees of a self-managed super fund would outweigh the benefits of just leaving it in even in a cash fund in an industry one. Even if you've got a small balance, I've seen some people with a balance of maybe under 100 grand or around 100 grand set up a self-managed fund to hedge other investments they've got outside of super. So that could even be, people sometimes hedge with gold or silver bars, assets outside of super, like shares or property, where they want, a metal, like a valuable metal, to offset or hedge some weird things might happen with the property market or the share market. I've also seen people with smaller balances set it up to invest through businesses, or angel invest or lend money, some of the topics we'll talk about today. So there's some examples where it doesn't always make sense, or there's a dollar figure that makes sense for everyone. But there is a ballpark. There's a ballpark that if you Googled, how much do I need to set up an SMSF? Most places would say between $200,000 and $250,000 in super as a break even on a costs perspective. So a cost of leaving it in an industry super fund versus setting up a self-managed fund. Now keep in mind that 200 to 250K is the combined balance of the number of members you've got in your fund. So if it's just you, then that's your balance. But if it's you and your partner, then you need to look at what's your combined balance, and do you kind of meet that rough guide to break even. So yes, so that's some guidance. Now the other thing I'll mention as well, and it's maybe a bit of a warning to people who are considering one, is the SM in SMSF stands for self-managed. So you actually have to be actively engaged in making decisions about what you invest in, about doing the documentation and the compliance side of things, and making sure you're doing the steps needed to look after your money. Now, as accountants, or our role with the SMSFs we look after, is to hold our clients' hands through that process, but it definitely isn't us doing everything. You do need to be actively involved in that, and so there's things that we need to make sure you're up for it with setting up an SMSF, it's not a set and forget thing, but the benefits are huge if it's done right. Okay, so I can see, Vivian, you've got a question there, but I might keep that one to the property development section. Now, yeah, feel free to ask any questions as we go. I haven't seen any others come through, but I might move on to the next topic now. Alrighty, so I want to cover over on the tax side of things. So there's kind of a couple of different tax rates for super. And the two main differences, or two main, what would you call them, zones of a superannuation, is when you're accumulating your balance, and that's throughout the majority of your life, when you're contributing to super, building it up, and then you reach a point where you might retire or start drawing a pension. And then as long as you meet certain conditions, your tax rate literally turns to Cayman Islands, and you're paying 0% tax on your profit, which is pretty cool. So we can access 0% tax rates in super if the conditions are right. So I might, I just saw a raised hand. If you do have a question, I think Lisa, you popped your hand up. Just pop it in the chat box, and we can get that sorted. So yeah, so 0%. The kind of two. I'm not going to say this is all you have to do, and there's details with this, but if you're retired and over 60, generally your super balance will be tax-free on the profit that it earns. Now, the other thing that the government brought in a couple of years ago was actually that 0% tax rate is limited to $1.6 million per member. Now, the $1.6 million cap for the 0% tax rate, that's when the pension is created. So there's actually quite some complexity there with your pension balance and switching it to pension mode under that $1.6 million cap. But broadly speaking, if you've got husband and wife, they've got $3 million in their fund and they're about 50-50, or up to $3 million in the fund, you can assume that maybe most of that profit that will be earned, or the investment income, will be tax-free, assuming they're over 60 and retired. Now, I've also added a tax rate here on the right-hand side here, which is non-compliance. So I've never seen this happen, but I've heard it's a possibility where if you do the wrong thing intentionally, there's a 97% tax, or it's really tax and penalties. And it's not of your income, it's actually of the fund's assets. So if you've got $1 million in super and it might earn, 50 grand a year in income, they're going to take not 90% of that 50 grand, they take 90% of your $1 million if you intentionally do the wrong thing. So the penalties are huge, if you disregard the rules. So don't do that. Now, just having a look into the chat box, we've got a question about the pension maximums. Kevin, I did mention $1.6 million per member, and I think that balance indexes from the year it was created. Thank you, Elisa, for pointing out that typo. $1.6 million per member for the pension fund for Kevin. And so if there's two in the fund, then it's not $3.2 million per the fund, it's actually still 1.6 per member. So if you've got a member that's got $2 million in their pension, and then you've got the other one who's got, using your example, they've got $1.2 million in the other balance, and the person who's got more than 1.6 mil, if they convert that to a pension, they will not get the 0% tax rate on the 400 grand that's over the limit. So it's not a per fund limit, it's a per member limit, just to clarify. Cool. All right, so there's the tax stuff. Now, capital gains is a little bit different in super compared to outside of super as well. Outside of super, you get a 50% discount generally if you own an asset for over 12 months. But inside of super, it's not a 50% discount. It's a third discount. Now, what that does is if you're accumulating your balance, then your tax rate goes from 15% for capital gains to 10%, given it chops a third of that tax rate off. So 10% on capital gains for assets held more than a year. So that is another fun fact for CGT. Alrighty, we are moving on. So now we're into the section on commercial or residential property. Now this one, I would love a little bit more interaction, if that's okay, with what you want to know about. So I can talk generally about this stuff, and I've got a few points there to talk through. But if you've got some scenarios you want to run by, and you're happy sharing those in the chat or the Q&A, I would love the prompting. And again, Vivian, I've got one specifically on development, so I'll cover that there. So what you can do with property, you can access bank funding. Now, a lot of banks have actually pulled out of SMSF lending, and they did that, I'd say about 3 or 4 years ago. All the major banks were into it, CBA, NAB, ANZ, they loved it, but they all pulled out once it sort of was seen as a little bit riskier. But there is still a few lenders in SMSF lending. So you can fund property through super. Now you can fund commercial and you can fund residential. The LVR, or the loan to value ratio with SMSF lending, really depends on the asset that you're buying. What it's being used for, what's the income going to look like for the bank, and they basically price how much they'll lend to you as a percent based on what it is. So what we usually do there is the client says, look, here's the property address, and we get the broker to have a look at what percentage that we can get lend there. So obviously metro city areas are easier or higher LVRs than sort of more rural, but there's some pretty cool opportunities for bank funding there. And also, I might mention as well, you can actually use your money outside of super to lend to your own SMSF to buy a property. So we've also helped clients do that, where they might have significant amount of money outside of super, and they want to use that to purchase an asset in super. And they pay themselves back interest and principal repayments from their own SMSF. Now, I have seen a couple of questions come through, so I'll go through those. Kevin, are the normal deductions applicable within SMSF for property? Generally, yes, they are. So we get depreciation, we get repairs and maintenance, we get property management fees, all tax deductible. Are lending rates for property in SMSF more costly or higher interest rates? Absolutely. So in some cases, they're double what you could purchase. You purchase a property outside of super, you might get 2s or 3s, maybe 4 is high percent, and inside of super, 4 is low. 4 is on the very low end. We're seeing 5, 6s, 7%. And again, it depends on the type of property, like commercial resi, what's your LVR, and literally the bank prices it per deal. So it's not like any old bank where you can go and look at their rates on the website. They give you some guides, but it's really, you need the scenario to run past the bank there. What's the typical leverage you'd use? That depends really on so many things, but yeah, you can go up to 70, 80%. I've seen 80% LVRs with SMSF lending, Kevin. Rashesh has said, can SMSF lend to trustees at commercial rate for business loan purposes? I will cover that shortly. That's becoming your own bank with using your SMSF money. Heather, can you buy your principal residence in an SMSF? No. Cannot own or occupy residential property. So that's a big no. You can also not buy a property and let your son or daughter or your relatives live in it either, if it's residential. But you can do it. You can own or occupy commercial property. So we've helped heaps of clients buy a commercial property where their business pays rent to. So that's totally fine. Jenny S, your question is, can a member borrow money outside of super and on lend to SMSF at same rate in terms of loan? Jenny, there's two questions there. Can a member borrow money outside and on lend? Yes, they can. At the same rate in terms of the loan that they got? Generally not. So you need to, so SMSF lending is really complex. So it's called LRBA lending, or limited recourse borrowing arrangements. So what we need to basically do is, if you're going to fund your own purchase in super through what you've suggested there, we actually need to look at what's a commercial term and rate that you could get offered by a bank from your SMSF, and we almost have to have the same arrangement with you personally. So even though you're on lending the money at maybe 3%, we would need to find a commercial deal that another lender would offer outside related parties, and then use the same terms there. You know, the ATO's cracked down on 0% lending and things like that in super. It used to be a thing for people to boost their SMSF balance, but yeah, be very careful there, Jenny. Your other question, can SMSF repay directly to bank, or must be to the member and then the member repay to the bank? You kind of got to separate. If you do something like that, you've really got to separate the relationship between the SMSF and the member and the bank that they're borrowing the money from. Also, your questions there are relatively simplifying a very complex setup. So that, yeah, need to be careful there. Now, Vivian, you've asked a couple of questions here. Can I contribute cash from my SMSF to BUA? Vivian, there's ways you can do that, but it's not simple, and you might need to involve other unrelated parties. Good question, Vivian, as well about contributions. So Vivian's asked, can I contribute more money to my SMSF more than my 25 grand annual contribution? So yes, you can. I don't have a contributions slide, which would actually be a very helpful slide. So there's two ways you can contribute to super. The first one is as a tax deductible contribution, or what we call concessional contributions. Now, concessional contributions, you're capped at $25,000 per person per year. So that's the limit of tax deductible contributions. Now, cool fact, from the 2019 financial year onwards, if you don't use all of your 25K contribution, let's say you only use 10 of it out of the 25, you can carry forward your unused amount going from the 2019 financial year onwards for up to 5 years. So you've got up to 5 years to go back and use up, 5 years as it goes contribution limit. So that's pretty cool. Now, with concessional contributions, your super fund pays tax on those contributions at a rate of 15% when they go in. There is a higher tax rate for higher income earners. I can see a few names in here who have the pain of experiencing what's called Division 293 tax, which is basically doubling the tax that your super fund pays on those contributions, which is a pain in the neck. But that's unfortunately another rule that they brought in a few years ago. But that's concessional contributions. Now, there is something called non-concessional contributions, which the limit at the moment is $100,000 per person per year, per income year. And you do not get a tax deduction on the money when it goes into the fund. But on the flip side, your fund does not pay tax when it receives that $100,000. So that is generally the two types of contributions. Now, with non-concessional or non-tax deductible contributions of 100 grand, there's a special rule if you meet certain conditions where you can bring forward that $100,000 contribution. So if we're in the current financial year, which is the 2021 financial year that we're in right now, we can look at 2022 and 2023's limits and bring those forward and put $300,000 in this financial year if we meet those conditions. That is also another option as well. So that is the contribution slide that should have existed. And no, Vivian, that won't impact your tax, your personal tax, that $100,000 non-concessional contribution. Rashesh, what are the good rates for SMSF borrowing? I'm not really going to cover that, Rashesh, sorry. Apart from saying that 70 or 80% LVR is okay, but you do start to pay 5, 6, 7% interest the higher it goes. Which banks are good options? Yeah, there's a handful of banks who'll lend to SMSFs, and again, it just depends on what you're looking to do there. Also, Kevin asked a tax question: are net earnings taxed at 15%, income minus deductions? Generally speaking, yes, Kevin. If you're accumulating your balance, income less expenses, tax deductible ones, you'll pay tax at 15%. Also, I don't have it on the slide here, but with property, you can actually access negative gearing and depreciation benefits inside your super fund, like you can outside of super. So negative gearing works where your property, even it might be cash flow positive, so you might be making a net cash income, but due to depreciation on that property, you're actually making a tax loss. So that tax loss can actually come off your super fund's income, and you won't pay tax on that loss, the tax loss or the portion of that. And it might reduce your tax on your contributions. So we've seen funds where, husband and wife might be putting 50 grand a year in it, but because of property negative gearing, they might only be paying tax on 10 grand or even less, or no tax at all due to negative gearing, which is pretty cool. Kevin, any dividend imputation? So yes, super funds get franking credit refunds. That is a whole nother slide and a whole nother webinar. That is, yes. So if you've got shares in BHP or CBA or listed stuff, or even, I won't complicate it, let's leave it at that. But let's say CBA shares, you get a dividend paid to your SMSF, you pay 15% tax on the dividend, you get a 15% credit or refund due to that imputation credit or the franking credit. So that's cool. Okay. Rashesh has asked, do you recommend individual trustee or corporate trustee? Cool. We will never, ever, 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 ever set up a self-managed super fund without a corporate trustee. There are administration benefits to it, and the estate planning benefits are insane when you compare it to individual trustees. Individual trustees are relatively nightmares compared to corporate trustees. Now, Rashesh has also said that why is 80% of new SMSFs using individual trustees rather than corporate? My guess would be simplicity at the setup and also price. So it will be cheaper by $1,500 maybe a bit less than that to set up individual trustees rather than corporate. But I will never do it. If a client said, hey, I want an SMSF and I insist on an individual trustee in my setup, I will say, no, we won't do it. Go somewhere else to set it up. And even the admin, it's like, it's not great. We have helped clients unwind that and transfer from individual to corporate trustees. But again, even there's some on the call today who have done that for, and even the paperwork for it and the time it takes to do that is crazy. And if you are in individual trustees, any new members or any exiting members or members who die, you need to do all that paperwork every single time. It is not fun. I'm going to stop on my bandwagon there. There is lots of questions. I'll leave the property development one. Anonymous attendee, I'll need a little bit more context. I'm going to, more context, I'm going to send a message back to you. If you could just do the question again, please. Con has asked, can you lend money to a son, not part of an SMSF, who is a builder to build an on-sell property? I will answer that in my next slide, which is become your own bank. You are providing awesome value, Ben. Thank you, Dashan. Thank you. Appreciate that. Thank you, thank you, thank you. Cool. So I'm going to keep on moving. In fact, I'll just check I've covered everything here. This is a good one. So when you're buying property in super, you cannot do certain transactions with borrowed money. So the ones you can do is you could buy an established property. So let's say there's a house down the street, resi or commercial, don't care. You can buy that with bank funds or that limited recourse borrowing I mentioned before. You can do that. You can also buy off the plan property, because you go for finance on that when the thing is completed or built. It's just that you can buy it a year or two in advance before it's even been constructed with a deposit in your super, and then the bank funding comes in when it's complete. What you cannot do though is buy a block of land and build a house. The house building part cannot be done with borrowed funds. It's a really weird rule. They call it something along the lines of the single asset. You only can borrow money to build a single asset. And even there's been some certain cases where an SMSF has borrowed money for a apartment purchase where the car parks are on a separate title to the apartment, and that's considered as two separate assets. But if it's one contract with two assets, that in a weird way breaches the rules of SMSF. So we need to make sure whatever you're looking to buy there, with funded, like bank funded or self-funded money, we need to make sure it's all legit. Sorry, I've just mentioned it there. We cannot fund a build with bank money, but we can fund a bit. Like you can fund the block of land through the bank if a bank will lend for that. Never had it before, never seen it before. Sorry, and then you can use your super fund money to actually build the house on it, as long as you're not using borrowed money to construct. That's the rule. Sweet. Next one. Become your own bank. So there is a few questions on this one. The general rules are that you can actually loan money with your SMSF. So a loan to another person is considered an investment. So what you need to do is make sure you're charging an appropriate interest rate and appropriate term and appropriate security for that loan as well. Now there's a couple of distinctions. If I was using my SMSF to lend money to pretty much everyone on the call, I can't see any family members on the call, then I don't really have a maximum amount of my super that, or maximum amount that I can do before I start breaching rules. I will say that, but loans are high risk in terms of high risk investments, especially if you don't have security on the loan. So if your gearing of your super fund is so heavily weighted towards lending money to other people, you may have a diversification issue in your fund. So there's technically no max, but you do need to consider diversification. So I wouldn't set up an SMSF with 100 grand in it and then $99,000 is lent to other people. You do need to consider diversification. If you've got a related party though, there is a maximum for related parties. So Con, this is actually going to answer your question here. Can I lend money to a son who's not part of my SMSF, who is a builder, to build and on-sell the property? Now I've got to be very careful here because you've complicated it with your son directly. So what I'm going to answer this as is, can your SMSF lend to a trust or a company that involves a family member? then the answer is yes, but only up to 5% of your super fund's balance. Now, the rules we need to be careful of here are called the in-house assets rules, or another way to think about it is the naughty asset rules. So the naughty allowance is up to 5% of your fund. So if you've got $1 million in your SMSF, net assets, so your assets less your loans and debt and tax bills and stuff like that, assets less debt, net assets are $1 million, then you could lend up to $50,000 from your SMSF to a related party company or trust. So you cannot lend directly to your son, Con, or a relative directly, but you could have an agreement between. So his building company, as an example, you could fund that side of things as working capital for the business. And that's actually something that a couple of our clients have reached out about is, with COVID, can they access a bit of their super to help with the business short-term cash flow? And the answer to that is yes. You need to document the loan. You need to make sure that it doesn't go above 5% of your fund balance at any one day, by the way. So let's say we're back in February 2020, before things hit the fan, and you had $1 million super fund balance, and you lent 50 grand to a family member, a company or trust, and then you're right on that 5% line, right? And let's say in March, April, when the stock market shat itself and you lost 30% of your fund balance, so your $1 million went down to 700 grand, at that time, you've got that loan that's above 5% of your fund. So there goes the alarm bells and the warning sirens of non-compliance. So do it with caution, please. It needs documentation. And yeah, so related parties are, we don't love them, but in the right circumstances, we can document them and work them out. Also, thank you, Rose, for mentioning, Rashesh asked earlier, can SMSF lend to members at a commercial rate for business loan purposes? So I kind of answered your question as well there, Rashesh, not directly to the member or the trustee or the person acting as a trustee, but to a company or trust associated on those same guidelines. So the in-house asset rules apply, commercial rates of interest, and maximum amounts of loans. Wunderbar. Alrighty. So we just got a property purchase question from Mark. Yeah, I think, Rose, that's also incorporated in the answer. That's good. So Mark's question is, can a number of SMSFs buy commercial property as joint tenants in common? So Mark, that's a complex one. There's a few different structures we can look at. You've mentioned a few of them. We can also look at setting up a trust, a unit trust that multiple SMSFs invest in. And that's probably the more flexible structure to do something like what you're suggesting, where you've got multiple SMSFs investing in a property. The unit trust allows a little bit more simplified exit strategies for different members, where you're not having to sell the underlying investment. Okay, gee, 45 minutes down, 15 to go, and about half the slides left. All right, so investing in private companies. So there's a few different layers here. So let's put an angel investor hat on. So let's say we're the sharks off Shark Tank, and we've got people asking to invest in their business for 5, 10, 20% holdings for, I've seen some ridiculous pictures there, by the way, but, but you can actually be an angel investor with your SMSF. There are also rules around this. You must be a minority or less, or 50% or less ownership in that entity, and you can't be seen on paper to have control, or even connoted, like what's the word I'm looking for? You can't even have effective control or persuasion over the board, or your decision can't be the final decision when you own that business or that stuff through super. But we have got clients, and I have even personally invested in businesses that meet these conditions. And the benefit of this is that the profit that that business or that investment earns goes to super, and you're taxed at 15% or 0% depending on your circumstances, and it's fantastic. So again, you do need to keep in mind that issue of control, and you have to, especially if you're looking to go into business and own through super, you need to keep in mind you need to relinquish absolute control of that. So yes, there's definitely different ways you can do it, but you can invest in friends' businesses done right, all sorts of that. Now, there doesn't seem to be a heap of questions with this one, so I might actually keep this one really brief, and we can move on. Hey, property development. So there is a couple of property development questions. Now, property development in super, the reason why it's so attractive is because usually with property development, it's hard to get access to bank money to fund projects, especially when you've got no experience at property development. So the attractive point of property development is that you can often, especially if you've got friends who are cashed up in their super funds, you can pool money together. And as long as you structure it right, you can access millions of dollars worth of funding to go and carry out property development. And again, the other benefit, like everything with super, is that the tax implications on it. They're usually very light on with tax. So there's some good reasons to do it. So just having a look at the questions to guide me, and please add questions if you do have stuff about this. Can I have, and Vivian, I might kind of change the language of this, given I know it a bit. Can I have a current project that's going on outside of super under my SMSF? So, and I'm guessing the profits to go to the SMSF. Now, if you've got a current development that's going on outside of super, it would be very difficult to get it inside of super, or the ownership of the land and whatever is being carried out there. The reason is because there's very limited ways to get assets transferred outside to inside super, and also inside to outside of super. So there's limitations on what you can put into super, and it has to be commercial property. So we can actually, if you've got a commercial premises held outside of super, your super fund can buy that off you. We've done that many, many times for clients, and there's some great things we can do there for cash flow and tax purposes to help that out. And the other thing you can transfer into super is market listed shares. So ASX listed stuff, that's very easy. The rules basically say you can't transfer anything into super apart from those two things. So if you look at a property development, we really need to make sure we get the ownership of the development site right before we go and start the project. Or before we even buy the project, we need to make sure the contract to purchase that block is in the right name. So yeah, Vivian, I don't think it's viable for the current project to be in super or your SMSF for many reasons, but apart from the super rules that prevent the transfer. But your next projects can definitely be inside super. That is totally fine. And what we usually do with property development with super funds is just make sure we advise you on the correct way to purchase it on every single project, because every project's different, got different funding requirements, might have different implications for needing ABNs and GST and all that sort of stuff. Damien's also asked a question, does the SMSF have to own the underlying asset rather than fund the development and the construction costs? The answer to that, Damien, is we've done it either way. So there's no one way or the other. How some clients usually come to us here is saying that, hey, here's what I want to do. Can you give me my options? I've got these people who want to be involved or can be involved, and we kind of put together the best outcome for the client based on tax, based on access to funds, all that sort of stuff. Usually where there's a will, there's a way with property development in super. And Vivian, I might say if we advise you from the start there. I'm just checking if there's property development ones. If I own a second property, can I transfer to my SMSF or can it buy it? Laurie, the answer to that one is if it's commercial property, we're good to go. If it's resi, no, we can't do that. Jenny S, any tax on transfer of listed shares to the SMSF? Now, if you own shares, let's say you own shares in your personal name and you transfer them to your SMSF, that is deemed to be a disposal of the shares in your own name. So you will have CGT implications when you transfer them in. So the answer is yes, not guaranteed tax. If you haven't made a gain, there won't be any tax. But if you have, you will. Keep in mind, you also get a tax deduction if it's a concessional transfer or concessional contribution of funds into your SMSF. We can weigh that up and see whether it's worth it from a tax perspective. Rashesh says, under diversification rule, this is on property, people who buy property using limited recourse borrowing is most likely the single biggest asset allocation will be direct property. Is it not an issue? It's something to consider. And in fact, the ATO wrote to thousands of SMSF trustees, I think it was in the last 12 months, and said, hey, we can see by your tax returns that you've invested more than 90% of your funds in one asset. Now, that can be a contravention of the super rules if your investment strategy doesn't consider diversification. So if you haven't thought about diversification, basically, you might be stuffed, but it's all in the documentation, is basically the answer to that. And Rashesh, there is actually no legal legislated limit on what percentage is your maximum in one asset class. So we've seen funds with 100% cash, and technically that's more than 90% in one asset. But if there's reasons that are documented why that fund is invested that way, and they make sense, then we're good to go. Same with property. If you're weighted 97% property, and there's diversification considered, good to go. Dan Begley, is it difficult to get finance in an SMSF, either for shares or property purchase? So I don't think a bank's going to lend you for share purchase, like margin lending in super, but you can, under certain rules, you can fund with outside of super money, you can lend it to your SMSF to buy shares. That's complex and you'd need to have a good reason why, but we can do that. And then property purchase, it's not really difficult. In fact, the application form for finance in super is actually like 3 or 4 pages long versus outside of super. If anyone's gone for finance recently, it's usually 30, 40 bloody pages of stuff and all this sort of stuff. So it's actually an easier application process in most cases with SMSF funding. Thank you, Rose. We've got 5 minutes left. What have I got left? We're almost done, actually, which is good. Dashan, when I can really withdraw profit from SMSF, is it only after I turn 60? Is there any other way? I'm in my early 30s. So if you're a member, drawing a pension is only possible where you've met preservation age. Now, there is so many rules around this, but preservation age depends on when you were born. So if you're born after 1964, which maths is suggesting you are born after that date, your preservation age is 60. If you're born before 1960, your preservation age is 55. So we might have a bit of a mixed bag on the webinar today. But your preservation age is when your super is accessible as long as you meet some additional what do you call it? Additional conditions. So let's take the most common one, which is retirement. So if you're over 60 and you retire or you cease employment, is actually the way it's written, then you can access some of your super. You don't have to be retired when you hit preservation age to draw a transition to retirement pension. So you can access up to 10% maximum of your fund per year under a transition to retirement pension. And then once you hit 65, you don't need to be retired to necessarily to draw down on your super, which is pretty cool. So there's a whole heap of layers there. Now, if you're 30, so a lot of clients say that, or younger ones say, hey, why would I contribute to super? I can't touch it for another 30 years. Well, yes and no. So we've talked about ways where you can fund other projects, like develop property. So you can lend money to, you can develop property, especially if you've got another unrelated business partner. There's ways you can access your super balance there to fund outside of super property development. There's some really cool things we can do to not necessarily access the money to spend personally, but access it to grow our wealth. There's the distinction, Deshaun. So yeah, yes and no. So yes, you can't just draw the money out. But to say it's completely untouchable and it's just useless to you is a misconception of super when you're young. Yep, that one's done. Just rapid firing some questions here. Vivian, can you revise the lease agreement for a commercial property renting from the SMSF to have a higher rent? Now the rent, if you're a related party tenant, in your SMSF property, then you have to charge market rate of rent. So if the market rate goes up, then yes, you can renegotiate with yourself to raise the rent on that one, as long as it's market. And I would use substantiation through real estate agent appraisals, or if you can find other comparable leases or even square meter rates that are being advertised, that's all substantiation in case you're ever asked about how you determined your rental rate. Rashesh, many people use SMSF to trade Forex, futures or CFD. Don't know a lot on that, Rashesh, sorry. I guess nothing triggers to say it's not allowed, as long as there's no lending within those things. And yeah, I haven't seen much of that. Is related meaning I'm director of both entities? Vivian's asked. Related means you're a director or you control those entities, or even your extended family are caught under that related party. So you can have cousins who are, renting the business premises from your SMSF, and technically they're related party through family. Lynn, if I buy a resi property in an SMSF and rent it out, once I retire and I'm at preservation age, can I transfer it out into your personal home and live in it? Yes. So you do need to consider tax and stamp duty on the transfer out though. So you can transfer that asset out as a pension payment. And it'll be a big pension payment down the track, but yeah, you can. Elisa, thank you. Yes, I am right on time. Thank you, Elisa. And I've got two examples which I'll come back to, but I just want to mention two more things. The first one is, if you do want to talk more on this stuff, it's complex as you can book in for a strategy call. We can talk through some more about your circumstances and see if there's any room to help. That's option one if you do want more. Now, this is unrelated to super, sort of, but we do have a federal budget webinar next week on Thursday the 8th. The federal budget wasn't released in May as usual this year due to COVID, but it is being released on the 6th of October, on basically Tuesday next week. But we're going to do a webinar on the Thursday after we've had some time to work out what impacts it has on business owners, self-managed super funds. So we will cover anything relevant for SMSFs, high-income employees or investors. So anything related to those 4 categories of people. So if you do want our budget debrief webinar, then Rose, would you be able to pop the link in the chat box to everyone, just of how you register for that one, or just send a message if you want us to invite you to that one personally. So that's going to be exciting to see what happens. And I've already seen some cool releases from our current government on what they're doing around that for manufacturing and tax rates and things like that. So it's going to be exciting. So if you do need to jump off, that is totally fine. But I'm going to go over by 5-10 minutes just to talk about tax havens in super and answer any other questions that come through from people. Just saw that Rose has posted the link to the federal budget webinar as well. So click and register for that one if you haven't already. But I've kind of got two things left: tax-free business profits and tax-free capital gains tax, or CGT. So I might cover this one first, which is basically some sort of examples of what I've talked about in play. So let's say that you run a business and you want to buy the premises, and then the premises is worth about $1 million, and you're 40 years old. You might fund that, mostly from the bank at the moment. So, maybe 600-700 grand from the bank, the rest from your SMSF. And over the next 20 years through to retirement, you pay that loan off to the bank and you've got a fully unencumbered asset. Now you bought it for $1 million, but it's now worth $2 million. So you made $1 million gain on that. Now the timing of when you sell that asset is huge from a tax perspective. If you sell that once you're in tax-free pension mode, then you'll pay 0% tax on your $1 million gain. Now that's impressive. Now, if you sell it and you pay normal capital gains tax in super, you revert to that 10% tax rate, which is the 15% tax less the 1/3 discount. So you'll pay 10% on your $1 million or 100 grand in tax, which is a pretty low tax, even if you are still accumulating your balance. So there's an example of potentially waiting till you're drawing a pension, you're in tax-free mode when you make huge CGT gains. Also, tax-free business profits. This is a bit of a cool thing that we've done for a couple of clients now. But if you've got multiple business partners looking to start a business, we can look at owning that in your super fund. I did touch on the idea of this earlier. And the cool part about that is the profits of the business go to your SMSF. Now, again, tax rates, you're accumulating your balance, you're paying 15%. But if you're retired or you've ceased employment after you've turned 60 and you've met those conditions of being 0% rate, then your profits that come through from that business might be 0%, which is a lot better than paying 30% or more outside of super. So pretty bloody cool, where you might have hundreds of thousands of dollars in business profits going to your SMSF tax-free, instead of paying 30 grand on every 100,000 of profit. So very, very cool. Cool. Well, that's about it for me. Just having a look. We are recording this session, Vivian. I just triple checked that, and we will be uploading it to our learning portal. And anyone who registered or tuned in live can access that one. That is no problem at all. And that's it. That's it. Thank you very much, Rose, for hosting this with me. And if there's no more questions, we might finish up. Thank you, Lynn. Thank you. And thanks, Vivian. Thanks, Jay. Good to see you here, mate. Thanks, Vivian. Really appreciate that. Thank you. Thanks, David. Thanks, Linda. Thank you, Jenny. Alrighty. Thanks, Dan. Awesome. Thank you, Laurie. One last question for Rashesh. Can we operate a business from super? Now, there's no specific law that says you cannot run a business from super, but often it's impractical because you might break another rule to run a business from super. So the way that I mentioned before about business partners using the super fund, thanks Junior, haven't seen you for a while, mate. Hope you're doing well. So how we get business profits to super is we don't run the business in the super fund, but we own the shares or the units in the entity that runs the business. So that's much safer, much simpler, and my blood pressure will stay at an appropriate rate if you do that mode rather than run a business in the super fund. Thanks, Rashesh. Alrighty. Well, that is about it for me this morning. And yeah, hope you enjoyed it. I loved it. I love self-managed super funds, and that hour disappeared really, really quickly. All right. Thanks, everyone. Thanks, Colin. Hey, Rashesh, the link to book a session should be in the chat box, but I'll get Rose to shoot you an email there. Oh, thank you, Rose. Awesome. Bye-bye.